This morning, we got results from Dover, the diversified industrial manufacturer that's made a big pivot toward the data center, aerospace, clean energy. We own it for the Charitable Trust. Wild ride. Dover trimmed their full-year forecast, which caused the stock to get slammed in pre-market trading. Oh, my God, it was down $6. However, on the conference call, management explained they were simply being conservative with their forecast. They're not seeing any actual weakness right now. They're being cautious. Rational thinking? Immediately, the stock started making a comeback, going on to finish the session up 2%. So can it keep running, or is this the kind of company we should genuinely be concerned about in such a tricky environment? Let's check in with Rich Tobin. He's the chairman, president, and CEO of Dover Corporation to find out. Mr. Tobin, welcome back to Mad Money.
How you doing, Jim?
Good, thank you. Now, Rich, I got to tell you, you did give it kind of like my heart jump for a second, because when I saw that that you basically were, let's say, concerned, I figured, uh-oh, you saw something. But what you really did see was what everybody's seeing, but no other CEO other than RTX really wants to say, which is that there is a bit of a zeitgeist and things going on. Can you explain to people how you chose unilaterally to make a decision about what could happen going forward?
Sure. About 3 weeks ago, when the tariff tumult really started to pick up steam, we got the management group together and basically said, you know what, you're going to get all confused with all this, so let's go back to tactics here. Let's get a real clean Q2 forecast. Let's look at our backlogs. Let's get a Q2 that we can deliver. And you know what? We'll wait to see how the smoke clears as we go through Q2. My experience tells me in times of uncertainty in corporate America, CapEx tends to get delayed in these situations. And there's a good portion of our business that's levered towards CapEx projects. I don't think they're going away. In our dialogue with our customers, they're all coming. But I think it's fair to say, as long as this tariff tumult doesn't get sorted out relatively quickly, that there's going to be a little bit of drift to the right. So it was purely a mechanical move. I did it from the center. At the end of the day, I don't think it's any reason to be excited. It's approximately $100 million in revenue, or 1%, and 17 million of net income. I mean, with the resulting, we're still double-digit EPS forecast for the year. If I reran our numbers right now at spot FX, it goes back the other way. But again, FX volatility right now is a little bit too close to call, so we'd like to get some time before we rerun the numbers.
Excellent. I'm glad you got that for our people, too. But I would say, Rich, that the intra-quarter trends here are actually quite encouraging. And if we wanted to, we could say that's history, or we could say that's how things could go if we get a little less crazy.
Yeah, look, we're really pleased with the margin performance in the quarter. And, you know this, that margin performance is not, what did we sell in Q1? It's all of the work that we did back in 23 and 24 and the roll forward effect of everything that we did on the portfolio, number one, all of the cost takeout that we did last year in terms of SKU management or footprint rationalization. So, look, we're in a time right now where predicting growth or revenue into the back half of the year is going to be a little bit difficult, but we're really pleased what we see in terms of the incremental margin performance that we saw in Q1, and we don't expect that to dilute going forward from
Well, there are also some excellent growth here. Pumps and process was terrific. Imaging and identification business I really like. These are businesses that we have come, the thermal connector business, so strong because of data center. These seem to have a lot of tailwinds behind them.
Yeah, I mean, I think the last time we got together, we said that we had invested a significant portion of both of our organic and inorganic capital over the last several years into some priority growth platforms that make up 20% of our revenue right now. They've really begun to get some traction now, number one, in terms of the growth rate, but more importantly, if you think about something like thermal connectors, we built a purpose-built facility 2 years ago. So not only are you getting the volume coming through, you're getting all of the fixed cost absorption that we've been carrying in the previous period. So, going the way we like it in terms of margin.
Now, can you put more money behind those, or so-called things that you feel like that at this very moment have momentum, or if you can't find anything, do you just take your considerable cash pile and buy the stock now that it's down 40 points from where it was?
Good question. I think right now, because we have a highly liquid balance sheet, we can do both. So there was a slide in the presentation this morning where we outlined some CapEx that we were undertaking. Unlike some of our customers that may not have the balance sheet position that we have, we don't have to delay any CapEx. We can keep spending for what we believe that is a multi-year runway of terms of growth. So we've got a variety of different projects right now for organic capacity expansion that we highlighted in the presentation this morning. In terms of intervening on the share price, I think that what we said coming into the year, with all the liquidity that we carried in, that we were carrying an insurance policy because of the presidential elections and a variety of other things going on. Right now, we're on the front foot. We'd rather deploy that in inorganic capital, but clearly, if we think that there's a dislocation in the stock price, that we'd intervene as we've done in the past.
You also did something that most CEOs don't do. You gave us a commentary on current tariff tumult, which shows me, frankly, if it's $215 million annualized tariff estimate on a 24 basis, well, I got to tell you, you are going to be better off than a lot of your competitors, and therefore you will also be similarly advantaged.
Yeah, look, I think that part of the reaction this morning was taking a look at those tariff numbers and not understanding what the calculation was. I mean, I don't believe that the Chinese tariffs are going to be 145% for a calendar year, but we had to give some guidance in terms of the exposure from a COGS point of view. We are, generally speaking, a proximity manufacturer. And as part of the comments I made this morning on the call was, we have a good understanding of where we are relative to our competitive base in terms of tariff exposure. And so it's not all about let's go raise pricing to cover tariffs and is that margin dilution. That was a lot of the questions we got this morning. It's more a matter of if you have an advantage against somebody because they're more exposed, because they're bringing more finished product in from China, for example, then let's go and be a little bit careful in pricing and let's grab some market share.
No, I want to just point out that one of the people I talk, you're in our club, so to speak, and we have a lot of club members, and they send me things. And one club member sent me something that was kind of interesting. He said, "Why does he own some divisions that are down? Why doesn't he own all divisions that are up?" Could you, and I tried to explain to them that's not the nature of the conglomerate, but maybe you can just speak to the idea of, look, they don't all go up at once.
Yeah, I think other than the real acceleration out of the COVID period, I don't think the portfolio has ever moved in tandem. Look, a lot of people like pure play. We would argue that the accordion effect of the portfolio is actually a strength at the end of the day. But having said that, we are stewards of capital. So we do have a clear-eyed view of sum of parts and how that drives the stock price. You saw us do some divestitures last year. I think that has been a result of our margin moving up over time, and then we redeploy the capital into, hopefully higher margin, higher growth businesses over time. Our engineered products division used to be 12 months ago 25% of revenue. Now it's down to 15%, for example, as we've pruned the portfolio. So, look, we drive for performance, and we would all want them to create value over time, but there is a semi-cyclical nature to the different parts.
Well, the consistent nature of Dover over multiple years would indicate it's not such a bad way to do business. I want to thank Rich Tobin, Chairman, President, CEO of Dover. I also want people to go listen to his conference call because his conference call is different from most others. That's all I'm going to say, other than it's often fun to read. Thank you, Rich, for coming on Mad Money.
Thanks, Jim.
Mad Money, back after.